Okay, so we're recording now.
So touch wood that if you see the door behind me pop open, I'll have to quickly grab below me because means my dog's managed to get into the room.
You're right to go whenever you're ready, Bryce. So go for it.
Very good. Oh, I just might do a bit of a housekeeping, Bryce, before we start. So thanks everyone for coming along virtually. This is becoming a bit more commonplace, as Andrew just said before. Zoom is really sort of becoming another great avenue to have these sorts of meetings, and I suppose we're finding it very good in using it to get information out to clients. And also we're recording this webinar as well. So I've had a few clients let me know they can't make it along. So they'll get a copy of the webinar and be able to sort of listen in. So I think Pete's putting everyone on mute. That's just to keep the background noise down. What else we got? There'll be a survey at the end of the webinar. So we're just, I know everyone loves surveys, but we're just trying to get a bit of feedback from people on other topics we can do webinars on, and also any other feedback to make them work a bit better. It's an interactive webinar, so feel free to jump in, ask questions at any time. There's also the chat box down below on your Zoom, so you can pop a question in there and it is getting monitored. And also as well, next month we have another webinar coming up. We're going to have someone from Heron Todd White give a CQ property update and sort of just see how things are travelling there in light of COVID. So that will be very interesting. And I'll just introduce Bryce quickly. So Bryce is from Vanguard. Bryce is currently in Melbourne, so he's a bit cooped up down there, but he's done another webinar for us before, and we've got him back again. So I'll let him, I won't steal his thunder this time with the Vanguard introduction. Yeah, Bryce gave us a great update last time, so I'm looking forward to hearing what he's got to say this time. So Bryce, over to you.
Yeah, perfect. Let me just sit up so I can share my screen. Perfect. Just let me know you all can see it. I just want to make sure I can get
All good, mate.
I'll just make sure I can see the participants because there was a couple of people joining late, so I just want to make sure no one's locked out of the room while I'm in control. Okay, perfect. I'll just sort this out. Okay,
And
again,
Bryce, just make sure you admit everyone into the room and you'll be all good from there. Yep.
Yeah, so I just made it so I can see the various screens just to make sure if anyone pops up, it should show me.
Okay, sweet. Thank you.
But yeah, thanks for that introduction, Brent, and thanks again for inviting me along. Hopefully last time went well enough that I've got the second gig. But as you mentioned, so I'm Bryce Layden. I'm a client sales executive from Vanguard. Today I'll run through quickly just who we are here at Vanguard, and then I'll move into providing an update on the impact we're still seeing from coronavirus. So that is still the main topic, unfortunately. And then I'll run through what we've seen occur in the markets over the last 6 to 12 months. And then to finish, I'll go through a bit of a global outlook and what we're seeing or what our expectations are for a returns forecast. As Brent mentioned, happy to take questions throughout. So just unmute yourself and jump in, or if you want, just put it in the chat box and Brent can bring it up for you. Before we do jump into it, just I guess a bit of a disclaimer and a bit of a reminder, everything I talk to today is general in nature. It won't unfortunately be personal to your circumstance. If you do require personal advice, just reach out to Brent or Andrew or any one of the people at Kenners, and they'll be more than happy to help you through your own circumstances. So as I mentioned, the business I work for is Vanguard. We're one of the world's largest wealth managers. We actually look after over $8.6 trillion. We've been around for over 40 years now, and we're originated out of Malvern, which is just outside Pennsylvania in the US. And we've actually been in Australia for quite some time now, over 20 years now. Our first office was in Melbourne, where our head office still is, but we've now got 4 satellite offices around Australia. Something that sets us apart from other competitors and other funds managers is our mutual fund structure. It's unique in that we're actually owned by the investor as opposed to having shareholders. So any profit we make doesn't actually get paid out to an investor, paid out to shareholders. It's actually retained and given back through lower fees. So as I mentioned, there's many things impacting the market at the moment. However, coronavirus still, unfortunately, is the largest influence. So that's where I'll start off with today. When we do look at the impact of coronavirus, we do tend to look at its economic impact, and that means we focus on GDP, or gross domestic product, and that's the measure of a country's economic output. We've seen historical falls here and large contractions globally as we're seeing each country tackle this lockdown and the impact we're seeing. We do see impacts to GDP and markets be related. However, we do actually see markets tend to price this in much faster, as they'll look to, I guess, forecast what the expected impact will be. Whereas for GDP, we do tend to look backwards and see what that impact really is. We're seeing coronavirus impact through a couple different channels, the first being domestic and the secondly being external impacts. And the first two effects we're seeing through these are supply shocks. So this is coming about through reduced supply of labour and production, and this is largely due to lockdowns throughout the economy, people obviously losing their jobs and then production slowing. We're then seeing this stem through, I guess, slowdowns in demand. So on the demand side, we're seeing people choose to stay home. They're reducing consumption. They're starting to feel the impacts of negative wealth, or I guess feeling a little bit uncertain in their own environments. And we're also seeing businesses start to reduce the amount they're expanding. I think a lot of people are a bit hesitant to spend money on expansion right now, and we're seeing that flow through, I guess, a reduction in demand. And as this is a global pandemic, we're seeing this also at a global level in demand and supply. So with disruptions to global supply chains happening, I mean, we all probably would have experienced it in some sort. If you ordered anything online from overseas or dealt in any of that capacity, you would have seen a big slowdown in trading between countries. And that's what we're seeing flow through this sort of loop around reduced demand and then reduced supply and going along. And that's what a lot of stimulus is being pointed at by governments, to try and remove this cycle and try and break out of it. So as, I guess, economies and businesses start to reopen, hopefully we don't have that continuous supply going on. So there's a couple of people, admit them in. I thought it'd be good to just highlight here how we've seen the COVID cases progress throughout Australia. Unfortunately, it probably is a bit more of an indicator right now of where I am, so in Victoria, and what we're seeing here. So a lot of these increased numbers in cases would be pretty much Victoria's numbers. But it's probably a good example to show for the rest of Australia around just how quickly this virus can spread if we don't get the containment measures right. So it just takes, I guess, a few bad eggs or a few mistakes, and suddenly we can see it pop up again. One thing, I guess, one positive thing is we do think the bulk of the spread is behind us. So we're not expecting to see widespread lockdowns like we saw back in March and April, where all of Australia's had to go back into lockdown. We're expecting to see this sort of pop up in spot up areas. So what we've seen in Victoria, probably what we've seen now happen in Auckland being a good example, where they've gone over 100 days without a case, and then you see a couple and they go into a full lockdown, hopefully trying to use shorter, sharper measures to try and kick that in rather than letting it spread and then going into wider lockdown. And I guess, although we're starting to see positive signs around the numbers in Australia coming down, and Victoria as well, there is still a lot of uncertainty ahead. We're seeing this especially in the labour market. So the impact on lockdowns has been very substantial, even considering the huge amount of fiscal stimulus we're seeing pumped into the market. So here in Australia, that's the likes of JobKeeper, JobSeeker. We're seeing similar initiatives worldwide. We do estimate that in the global economy, there's probably been over 300 million jobs lost full-time in the second quarter alone. So when we're looking at official unemployment rates, these are at historical highs from an unemployment level. So we're trying to do, I guess, everything we can to try and reduce those numbers and get people back into work, or make sure their jobs are protected. And that's where, when we're looking at true levels of unemployment, we do also include this light blue area, which looks at unemployment, including furloughed workers. So workers who are temporarily kept on using things like JobKeeper, but it's sort of unknown whether or not those jobs are safe and will be kept on long term. And that's where the market is sort of looking at the moment to try and see, if we were to cut off JobSeeker and JobKeeper, those sort of initiatives, how much of that would actually be kept on, Fortunately, here in Australia, the initiatives being done have probably been pretty successful. I mean, we're only looking at a slightly above furloughed level to the actual unemployment, which is under 10%. It's a bigger concern when we start to look at UK, Euro, and the US when those numbers are 15% plus. So really high numbers that we should be concerned about, or at least take note of. The other thing here in Australia, this was pre-lockdown for Victoria. We are still seeing positive moves, but it will be much slower to come back, as Victoria does account for about 25% of Australia's GDP. So there are things to consider as we see these second round lockdowns occur throughout Australia and around the globe. As I mentioned earlier, Australia has placed a large emphasis on funding job retention schemes over other initiatives. It is a bit of a time will tell for these, whether these efforts will pay off in keeping jobs over the long term. We personally see this as quite a good initiative and quite good around keeping demand in the market. So, I mean, we've seen in previous events where there's sort of one-off payment stimulus and those sort of events. We don't see that as quite effective. I think we probably saw during the GFC with that payment, a lot of people either just saved it because they weren't in a good spot and they weren't actually able to go and spend a little bit more than normal, or they went out and just bought a flat screen TV or something to that likes. And that's not really creating the supply and demand in the market that we're wanting to see. So we think where the efforts we're doing are probably putting us in a better spot than some of our neighbouring countries. But I guess it is one of those ones we will wait and see as we roll back those employment stimuluses, how effective they've been in actually keeping businesses going throughout and allowing them to continue to hold their staff. And as we sort of talk about business activity and how the economy is going, our economists do like to look at what we call high frequency indicators. And what we're showing here is from pre-coronavirus level up at 0 to sort of the troughs in this green, so the worst, probably at the full lockdown levels, and how that's returning. So I guess what that means from a sentiment point of view, how much are people wanting to go out and return to these areas? I'm sure everyone on the line now has probably experienced when you were in lockdown, you're at home for long periods of time, you're cooking at home, you're probably ordering in. As soon as those lockdown measures came off, a lot of us probably did want to go out and go to a restaurant and eat a cooked meal that way. So we're seeing here a lot of those measures have to come off. The demand is returning. And probably a good thing to see as well from what we're seeing in Australia, we're seeing the spending intentions return back to normal levels, which is good to see. Unsurprisingly, areas such as flights and box office revenue, even if you probably did want to go to the movies at the moment, there's not really movies coming out. And flying, I mean, no one's really traveling for leisure at the moment. And even for work purposes, there's not many flights happening. When we look at the recovery of the economy, we believe it's going to happen in two phases. Often when we talk about what the recovery looks like, you might hear people sort of say, oh, it's going to take the shape of a V or a U. And what they're really referring to is just how short and sharp the fall and recovery is. If it's a V, obviously you're seeing a very sharp drop and then a very sharp increase. We sort of, not to sit on the fence, we think it's a bit of both. So we're going to see in phase A, we're going to see businesses, when they open, we're going to see a lot of demand return quite quickly and a lot of economic output return very quickly. So we're expecting to see that towards the second half of this year. Although flowing on further from that, though, we're expecting demand to return to certain industries much slower. A lot of higher risk industries, which I'll touch on shortly, but ones where they're not going to be able to return back to normal pre-COVID levels very quickly. And we're expecting that to drag on the economy and keep us from returning back to normal as fast as we'd probably like to. Around the shape of the recovery, I like to look at it more of sort of like a Nike tick or a Nike swoosh, whichever way you want to talk about it. But it's that short, sharp drop followed by a quick recovery, but then a tail off as we sort of slowly return to where we probably should have been. And this is sort of just touching more again on where we're seeing certain industries will recover much faster than others. So your low risk industries such as construction, wholesale trade, IT, and from low risk, we look at it risk to coronavirus impact. So with those industries, education being very much an essential, IT being able to operate very easily without face-to-face, and obviously being a lot more demand as we're all starting to work in new ways, through to high risk. So your retail trade, real estate, arts and entertainment. So a lot of those areas where probably demand will be a lot slower for people wanting to go back to those, as well as if we did see these second round lockdowns, like I know here in Victoria, those were the first things to shut down as we started to see cases rise. So we're seeing those at most impact and will take the longest to recover. Before I move on, I guess just around the GDP and what we've seen and with the impact of the coronavirus, just want to say, do we have any questions in the chat or in the room that anyone wants to raise before we move on?
There's no questions in the chat so far, Bryce.
Perfect, that's right. Sounds a little bit hard to see with all the screens I've got going on, but I'll keep moving forward. So what I'll look at now is just what we've seen happen in the markets over the last 6 to 12 months, sort of encompassing a lot of the volatility we've seen and then obviously the subsequent recovery. If you did join us last time back in May when I presented, you may have seen this same slide, but with very different figures on it. So at that point, I was showing the returns year to date to April, whereas now we're able to show you what's happened to July, where we have seen a pretty good rebound in the market since then. So looking at global equities, I mean, if you could remember last time, I think these were in the negative teens. So we've seen a nice recovery here year to date, where they're now sort of around 5%, and the US has done quite nicely off the back of it. And partly that is due to the industries they're predominantly in. So things like IT have done quite strongly, which make up a lot of the US stocks, which unfortunately we don't have a lot of here in Australia. So we're still lagging behind a little bit, with Aussie equities still down 8% year to date. And again, that's part of what drives a lot of the Australian economy around commercial property. So when we talk about Australian property, it's not your homes that you're living in or real estate on that side. A lot of it is commercial. So we're looking at office buildings and shopping centres, and those where understandably a lot of demand here has fallen and the market is a bit nervous about what that future looks like in that space. So how much business is going to go back, and will they need the same amount of office space they had before? Will businesses opt for a lot more online trading and that sort of thing? So that's why those industries are lagging a little bit. But from a long-term standpoint, I mean, the markets have performed quite nicely. I mean, if you're a long-term investor, which we advocate for over a 10-year period, I mean, you're still seeing nice returns, and you're really investing for the long term to see those compounding returns, knowing you will see short volatility in the short term. The market event we're currently seeing around coronavirus is very different to any other we've experienced for quite some time. So, and this is largely due to what it stemmed from. So it's a health crisis, firstly, as opposed to some of the other more financial driven crises we've seen over the last couple of decades. So what we've charted here is the number of days since the initial shock to the market of that event. So we've charted it against the GFC and the tech bubble burst in the early 2000s. As you can see, the coronavirus shape and nature is so very different to these other financial driven events. So if you look at the tech bubble, for example, from peak to bottom of the market took pretty much 2 years to see, and then subsequently 2 to 3 years to see that recovery back to pre-burst levels. Same with the GFC, sort of just over a year from peak to bottom as we started to see a lot more unfold, and then to return back to normal again, taking sort of 3 to 4 years, that market taking a lot longer to recover. Whereas with the coronavirus, we saw a very sharp reaction by the market when all the news came out, a lot of uncertainty about what the extent of these lockdowns would be, what that impact would be on the market. So pricing in a lot of fear and a lot of uncertainty. So we saw a very short drop of about 30 to 40% in the markets. And then since then, I guess, a bit of positive sentiment around the controls that countries have been able to put in place, businesses returning a lot faster than we'd expected. We've seen a quick recovery in the markets. A lot of that is driven by certain sectors. So some will still lag, which I'll touch on shortly. But overall, we've seen some industries actually return to pre-COVID levels already. So we've seen that in the NASDAQ, which is the around the IT stocks. So clearly they've been able to perform quite well over this period. So they're actually back to pre-COVID levels on their index. This is what I touched on around why sort of diversification is still quite important, especially in your equities, not just on a global point of view, but also within sectors. As you can see here, some of the strongest performers being your IT, your healthcare and communications, whereas we've seen, I guess, struggling performance in areas such as real estate, as I touched on earlier, very commercial side of real estate, your financials, which are very face-to-face driven industries, and then energy, which is predominantly oil and gas. So The reason for this is we saw oil prices drop dramatically in sort of mid-March. That was largely due to an OPEC deal falling through and subsequent flooding of the market by Saudi Arabia and Russia. And with those falling prices, we expected profits to drop quite significantly in this area, and that's why they haven't recovered just yet. So we're seeing them quite still at low. To bring that back to probably what maybe you're seeing in your own investments, if you do have some Vanguard or potentially similar index portfolios or investments in the market. From an Australian point of view, so what we sort of pointed to earlier, over the last 12 months to 30 June, so the 2020 financial year, an investment in the Australian market would have seen a return of around about negative 6.6%, which in all isn't actually that bad given, I mean, we've been through a recession-like event. So to actually only be off about 6% probably isn't the worst case scenario given everything that's gone on. But I guess it is sort of highlighting here the benefits of having some diversification in your portfolio. So we've seen Australian fixed interest time over this period return about 4%. And if you can look at this sort of line here, it's probably hard to see on your screen potentially, but it's a very flat line, which is what you'd expect to see from a defensive asset that's just not meant to, I guess, fluctuate too much with the markets. And if we look at diversified portfolios, so we've got our conservative through to high growth. What they are is they're a blend of local and international equities as well as fixed interest in various degrees. But all of these portfolios have actually returned a positive amount for the year. So that's where that benefits of having the diversification, not having all your eggs in one basket, sort of use an old saying, but where that benefit has come from. What I'll look to move into now is more around what we're seeing coming up in the future. I'll firstly look at a few other events which are impacting the economy, and then I'll touch on what our market forecast is looking like for the next 10 years. So as I've sort of focused on and touched on, coronavirus and the stimulus coming out of the governments is still the largest driving force in the market. However, I guess it's prudent to remember there are still a few other factors in play. So we do still have the US-China tensions which are occurring as well, especially as we head into the election in the US. And we've also got the Brexit playing out, which by the end of the year will need to come to a deal or result in a no-deal scenario. There are quite a lot of scenarios here that our economists have put together from downside to upside situations for each of these. I won't run through all of it, it's quite extensive, but we are sharing the slides afterwards. So if you are interested in reading through this, feel free to jump to this slide and have a read of each scenario. Just to quickly touch on the ones I haven't spoken to though, around US-China tensions. From our point of view as a base case, we don't expect that phase one trade deal to fall apart. We expect China to honor up to that and continue to purchase from the US. We see it sort of a bit of a lose-lose deal if they do let that terminate. Although we do expect tensions to continue to boil under the surface, but mostly around non-economic issues between the two parties. When it comes to Brexit, the reason we rate it quite lowly is it's sort of, I guess, European nature, so it's quite isolated to that region. It will have flow-on effects globally, but given everything else going on with the two powerhouses going head-to-head in US and China, and then what we're seeing globally with coronavirus, we just don't see it as a large-scale event of that nature. What we're expecting to happen is by the end of the year, we expect them to come to a bare bones agreement, at least to start with, which will hopefully allow a lot of those UK businesses and Europe businesses to continue to trade with one another on special conditions, as opposed to letting it default to World Trade Organization rules, which would be quite burdensome for a lot of UK businesses, as, I mean, you'd lose the ability to trade quite efficiently with a lot of your neighboring countries. Taking into account all of those scenarios and situations, our economists then look at, I guess, what the forecast is for the year from a GDP point, or I guess where we see ourselves ending. So as I've touched on, the second quarter, we saw large drawdowns in production in the economies. So I think in the US, we saw a 30% fall. Obviously, we saw large scale impacts of the coronavirus there. In the UK and Euro area, we've seen falls of upwards of 20%. Although we now look a bit more optimistic towards the end of the year as we see the economies reopen. We're expecting to see increases over the last 2 quarters of the year. As a base case, although for the full year, we were still expecting probably a falling global economy of about 3%. So not going to quite get to where we were, but we are expecting to see quite a nice recovery at an overall level, although some countries will still lag behind. So from those large falls, the US still will sort of be behind sort of 8% for the year. UK and Europe areas larger, over 9%. Whereas here in Australia, we're expecting to only sort of be off around about 4%, as long as we don't see too many pop-up new cases or trade restrictions with China, etc., anything like that. And then going into more of what we're seeing in the market. So when we look at forecasting, it's very difficult to look at the short term. I mean, there's still a lot of volatility and noise in the market that no one really will be able to predict. But when we look at forecasting, we like to look at a 10-year outlook. And the way we look at this and generate these return outlooks is by running over 10,000 simulated market outcomes, given a variety of conditions. So a lot of those things we touched on the slide earlier, as well as anything else that might impact returns. Just to sort of show you how you can interpret this. So this blue section in the middle here is what we expect to see as the most likely outcome, with the green being the optimistic scenario and the purple being what we see as a bit of a downside side. But when we look at these, we do tend to focus in the middle of what the most expected is. When it comes to equities, we've actually improved our outlook after everything that's happened in the markets. Coming into this year, we actually thought growth was going to slow. So what we've seen after the fall and subsequent recovery in the markets is we still think there's more room now for growth in equities. So we've raised our expectation from around 4.5% to now 5.5% to 7.5% when it comes to equities. Although when we're looking at fixed interest and bonds, we don't expect interest rates to rise anytime soon. I think there's a lot of indication from the RBA and central banks over in the US that they're looking to keep these interest rates low to try and help the economy. By keeping them low, it does allow a lot of borrowing and a lot of people to, I guess, want to expand as opposed to trying to restrict. So we're expecting this to stay quite low, with forecasts here in around about the 1% level. Although we do still see bonds playing a pretty important part in a portfolio, and we saw them play a very important part over the last 6 months, which I'll touch on now, around why you still want to hold these bonds in your portfolio, even though you're looking at going, if I can get 5 or 6% in equities, why would I want to hold a product that's got a very low return outlook? And the reason for that is what I touched on probably that performance chart over the last 6 months, where bonds had a very smooth return over the volatility we've seen, whereas we've seen equities fall and then suddenly recover. What we've shown here is a 100% global equity portfolio in that first 3 months of the year fell by over 30%, whereas in the bond space, they pretty much held par, giving someone with a blended portfolio a return of about negative 20%. So still falling, but managing to protect themselves from some of that downside fall. Whereas in the recovery, equities did increase by sort of over 37%, which you might think was really positive. Why would I not want to just hold all equities? And I guess the reason for that as well is if you fell 50% in your portfolio, to recover that, you need to double your money. So just if you fall 30% and recovering 30%, you're not actually back to where you were pre any changes in your portfolio. And I guess one thing we point out here is a blended portfolio for the year, for the 6 months, was only off about 1.5% compared to a fully equity invested portfolio, which is off about 6% still for the full year. And just to, I guess, summarize some of the key points we've gone through today, from a global growth point of view, we have seen historical falls over the last 6 months, but we are expecting a bit of improvement here over the next 6 months, where we're expecting to see nice recoveries in the markets. Around policies and interest rates, we're still expecting a lot of stimulus to come out of governments and a lot of propping up here. Although on the interest rate side, as I mentioned, we're expecting this to stay very low around that sort of 0 or 1% mark. And then on global asset returns, as I mentioned, we've actually improved our return outlook on equities as we think they're at a nice, sort of a lower valuation than they were pre-coronavirus levels. And then when it comes to economic recovery, as I mentioned, we're going to see a positive growth in economies over the next sort of 6 months. We're expecting a very short, sharp recession overall. But we do think for a full recovery, it's going to be at least 2 years to be where we were. And then from getting back to where we probably should have been now, it will take probably up to 3 years. Just sort of pass it around the room. Is there any questions anyone's got on anything I've touched on today?
There's nothing in the chat, Bryce. I don't know if there's any questions from anyone else. So that was a great overview. Thanks, Bryce. Everyone's quiet. If you check your mute, if you want to have a question, but
No, I understand. It is always a lot to take in all at once. So we will distribute the slides, as I mentioned. So if you do have questions that come up afterwards as you're sort of reading through any of those best case scenarios, all those sort of things, do feel free to reach out to Brent and he'll happily pass them on to me and our team here. And we're happy to come back with an answer.
Awesome. Thanks, Bryce. Thanks very much. Really appreciate you giving us that overview and update. As a bit of feedback from our last webinar, we had some people ask about maybe doing a bit of a education session on shares and what are shares and how they work. So if you want to hang around, I was going to do a quick overview of shares, and we'll record this again as well. But if you want to head off now, that's the end of the market update. So
That's right. I've got nowhere to be, so I'm happy to hang around. I'll, who do you want me to pass the admin
pass
to?
that back to me, please, Bryce.
Yep. Perfect. Thanks.
Awesome. Thank you.
I'm not the best with shares, Bryce, so we'll get to Brent. Yeah.
Did I pass? I think I passed it to Brent.
Yep,
Yeah.
got it.
Yeah, that's good.
Share the right screen now. That's the share screen 2.
Have you got any hot tips, Bryce, at all, or not really?
Not on the individual tips. I do occasionally get a few family friends reaching out, but as an index provider, just buy the whole market.
So can everyone see my screen there? And probably to that, I don't think I've seen some slides going around, Bryce, of, and I don't know if I can find one and bring it up, but when you're talking about the NASDAQ there, like the difference between the top 5 stocks being like Apple, Google,
Yep.
Amazon, compared to the rest of the market, then yeah, they've really kicked on. So it does highlight the benefit of, like, they've really saved the index as a whole.
Yes.
So having that diversified
It is interesting, obviously I didn't mention, but when you're looking at that communications line, I showed you a lot of the telecommunications have actually done quite poorly, but in that telecommunications, a lot of media companies, so your Netflix and Google's and all that sort of one, where people being in lockdown are actually still spending that money. I mean, it's not a lot per month, so people are still opting to have that service. So they've actually flourished and sort of propped up those indexes. And I guess that proves again why it's nice to diversify even within industries.
Awesome. So like Bryce got a general advice disclaimer. Basically, this is just general advice, not personal advice. If you want some personal advice, then we can give you that based on your circumstances. So I suppose that I sort of take it right back to the start, and I suppose to define what a share is, because I think people, look at the market and I think the whole concept of what a share tends to get lost a little bit these days. So really all a share is just a part ownership in a business. It's a way of, being an owner of a business. You can buy a share in BHP, and I'm not sure how many shares they got to offer. You're a drop in the ocean with regards to that, but you effectively own a piece of BHP. So with shares though, like when you're talking about the market becomes a mechanism for being able to exchange those shares. So really the share market is, I've gone too far there. I'll get this laser pointer up. Really the share market is just like any other market, whether it be, yeah.
I'm not sure if we're seeing the right screen. I'm just seeing a background.
Are you?
So make sure
No, we just got a background here. So just move it over if you can.
Okay, sorry.
Just got a leaf, that's all.
Yeah.
Hang on, mate. I might, it's gone a bit funny on my little computer here. I might just, close out of that one. I might try and reshare my screen. Is that better?
We can now see the icons. So
You can see us now.
Yeah.
Just drag your screen over.
Pick the right one. So share screen 3, share. No luck?
All good.
Seeing it
Yeah.
now. Yeah.
That's good there?
Yeah.
Cool. That's right?
Yep.
Excellent. So as I was saying, basically a share market is, they call it a secondary market. So basically it's like any other market, whether it be a cattle market, fruit market, it's where buyers and sellers come together to work out a price on basically, the exchange, the buying and selling. So that's what it is in its very essence. The tricky part, I suppose, is that there's no physical goods that exchange hands. It's these numbers on a screen, and that's obviously where money's sort of heading. It gets a bit confusing now. It can't be sort of seen or touched, and that's why some people probably, I know I get a lot of feedback, they shy away from shares because they rather property or something like that, something physical and tangible that they can touch. So bring it back to its simplest form, it's a piece of a company basically. And really all you get is a certificate that shows you how many sort of shares you do hold. So why do people invest in shares, and what are the benefits of investing in shares? Well, really there's three main reasons. So a lot of the time people are chasing dividends. So dividends are simply a share of the profit that the company makes and distributes out to shareholders. So if you have a diversified sort of portfolio of shares, or even if you grab the index, Bryce, you're sort of looking at about 4 or 5% in dividends a year?
Yeah, especially in the Australian market.
Yep. So you probably would have heard in the news a little bit lately, some of these dividends, particularly from the banks, are coming under a bit of pressure, and that's because of they're wanting to protect their balance sheets in these sort of difficult times. So they're not probably going to pay as much money out to shareholders. They're going to retain it on their in the business to protect it and help weather this corona storm. But as said, Bryce said, looking longer term, definitely shares provide attractive income through these dividends, and normally they're paid out twice a year. And obviously, as Bryce said as well, forecasts for interest rates are very low. So at the moment, term deposits are paying 1%. Dividends look very attractive relative to other sort of asset classes, as long as that company can pay that dividend. And I think, Bryce, correct me if I'm wrong, but that's probably driving somewhat the market up a bit, probably even possibly artificially at the moment, is people trying to get more return on their money.
Yeah, definitely. Especially, there's no free ride on the cash anymore. So I think people are looking for other ways to make money, especially over long term. I mean, we all have investment goals we need to reach.
With the dividends, sometimes come some tax benefits as well. So if a company is predominantly or 100% Australian based, then what they should be doing is paying tax in Australia at 30%. And basically, this is the big kerfuffle with the election, where pretty much Labor lost it over the franking credit debate, was this franking credit. So in essence, before you've got your dividend, the company's already paid tax on that money at 30%. So what then happens is when you get the dividend and you put it in your tax return, basically the accountants show it with these franking credits that 30% tax has already been paid. So depending on your own tax rate, you might get a refund of those franking credits. So that's where the retirees, if you're retired and not paying any tax on your super fund, they actually get that franking credit back. So that provides another little boost on top of that dividend income. And they talk about net income being the physical cash you receive. The gross income, including your franking, can sometimes push your income up to around the 6% mark. So that makes shares very attractive proposition. The other element of the return is the capital growth, or on the next slide, I've got capital loss. So with shares, there is a risk there. Now, longer term, as Bryce has sort of had on his chart, you need to take a long-term mindset with shares. So if we think about back to the simple component of what a share is, it's a piece of a company. You're wanting to buy into a company that's got a 10-year goal that's looking to grow over that time. Now, in between, there can be lots of up and downs. There's coronavirus, which causes things to go on, but you need that long-term focus. And if you buy into a good quality company that's got a good business, it's got a good board, It's got all the right attributes, and longer term, then they should grow that business. However, that isn't a guarantee. And on the next slide, I've got there, capital loss is a big risk, and probably the biggest risk in owning shares, because if a company fails, it goes bankrupt, then there goes your money in that company. But as Bryce said before, the old adage, don't put all your eggs in one basket. Diversification can really help minimise that risk of capital loss. And as I raised before there, with a dividend, it isn't always guaranteed. If a company doesn't make profits or it doesn't make enough where it can distribute, then you might not get a dividend. I know Qantas didn't pay a dividend for quite a number of years. The banks are on the nose there as well at the moment. But I think JB Hi-Fi recently increased their dividend because of all the people during COVID. They've had a really good run of it. So yeah, things can change there a bit. Do I have any questions at the moment, or if not, I'll keep going. So you can buy shares in a couple of different ways. The first one is the primary way, where a company will come to the market and they'll offer shares through a float. So that's where a company might be sort of looking to raise more money, or they might be looking to, what's the right word there, sort of offer shares out and offer people to come in to buy into the company to release capital for the existing owners. You can buy shares through that method, through what's called like a float, or they can be bought on the share market, which is through the secondary basis there. And if you want to buy shares directly, so you want to buy, say, like a BHP share or a Woolworths share, then you can use a stockbroker to do that. So you can use like a CommSec account, or you can use a fully serviced broker like we lean on Ord Minnett. They're the different ways you can buy them. You can also buy them directly, as I mentioned, or have it through a managed approach, which is sort of like through a Vanguard approach. So what are the differences and who makes the decisions? So with the direct share, they're owned by yourself. You can go through and buy them through a CommSec account, and you actually make the decision around what shares you want to buy, or you can go directly to a broker and they will help you pick and choose which shares might be the best for you. I'll just make this mention here. If people are buying direct shares, I do urge them to look at it making it CHESS sponsored. From an administrative perspective, having it CHESS sponsored makes it very simple. All the shares are under the one account with the one, they call it a HIN number, a holder identification number, and it starts with an X and has about 10 digits. The amount of times that we see clients, if they've bought them through an issuer sponsored number, so that means that it's a SRN, a security reference number. So you got an individual number for every single different share you hold. Trying to track down those numbers and even the differences in the naming protocols when you buy the shares, it creates dramas down the track. So if you take one thing away and you want to buy shares, make sure they're CHESS sponsored at least. The other option is if you don't really feel like you want to be taking the pick or the gamble on which funds or which shares you want to go into, then the other option is like through a managed approach. So this is sort of what a Vanguard does, is that you basically pool your money together with other investors. So Bryce, in the Vanguard Australian Share Fund, how much money is in that pot at the moment?
I'm trying to remember. It's a few billion now, so about 5. I think I need to check about 5. But yeah, it's a good way if you want to buy up the whole market as opposed to buying individual stocks, which can get quite costly.
So that's right. So you can buy into that Vanguard Australian Share Fund. It's a big fund. It's very cheap. So through Vanguard's scale, it's probably about 0.1% or something like that, or 0.15%. It's pretty cheap. And the benefits there are you get greater levels of diversification. So you own a number of shares. You don't just own, say, one or two, like a BHP and a NAB. You get professional management around it, and there's also plenty of flexibility because there's a whole different range of different Australian share funds you can go into. The only disadvantages are that you do lose a bit of control with those investments. Someone else is sort of managing it on your behalf, and there can be some high costs depending on the different the managed funds that you sort of go into. Vanguard's at the lower end, being an index fund. If you wanted someone who's a bit more active and made some decisions around buying and selling on your behalf, you can be paying up to 1.5 to 2%. So a couple of, I suppose, things about markets and performance. So just because the market's up doesn't necessarily mean that all investments are up. So what happens is when you see the news at night or Ellen Cole is on there and the market's down, that is generally because overall, most of the shares that are on the stock market are down. However, it depends on underlying sectors and their components. So it's the sum of all the parts. So for instance, the banking and finance industry is a large part of the ASX 200 or the share market. So I think they're about 20 odd %, Bryce, from memory.
Yeah, it sounds about right.
So if for instance, we have an issue down the track about coronavirus and people aren't going to be able to pay their home loans and everyone thinks, well, banks are going to suffer and lose all this money. Banks might have a really bad day. That might drag the market down. So there could be other shares in the market that went up for the day, but because the weight of that sector in the market, it drags it down. So just be mindful of that if you depends how your investments are positioned, but just because the market's down doesn't necessarily mean that your investments are down. And reporting season, that does a little bit to performance and what's going on. So we're going through reporting season now where companies come out and they sort of say what's happened for the last 6 months and what they forecast for the next 6 months. And depending on what the market expects the company to be doing. So there's a lot of analysts that research these companies and they might say, look, we think BHP is going to have a $1 billion profit and that's a lot of money. And say BHP come out with an $800 billion profit, then I forget what numbers I said there, sorry. So that $1 billion profit, they come out with an $800 million profit, which is under, the share price actually might go down because the market was expecting that they were going to have a higher profit. So there's all sorts of things that go on. Trumpy can send a tweet and that can send the market down because of the flow-on effects of the China-US relations. So there's all sorts of things that can go on with the markets. I suppose Bryce mentioned with the noise, you need to buckle in, set the long-term time frame and trust, I suppose, that the investments you're in are good quality investments and that you just ride them out, have a 10-year minimum sort of time horizon, which is what Vanguard have a look at as far as their long-term expectations and yeah, go from there. I did have a bit of a sample here. I'll see if this works. Just to sort of show you what shares are in. So if I can drag this across. Slow when we're on the Zoom. So this is the Vanguard Index Australian Shares Fund. You can see here that the distribution that it paid out, so that's basically the dividends for the year, was about 3.42%. And you can see here as well that the growth, so it's gone backwards a bit there as well for the year, negative 13%. But people tend to focus on the long term. So if you look longer term, they've delivered about 5.5% in dividends and income. So that's quite. Scroll down here as well. This is the diversification factor. So you can see here the top 10 shares that are owned in this fund are all your blue chip big names. So Commonwealth Bank, CSL, BHP, etc. And they actually make up 42% of the portfolio just because of the size of them as well. Just to contrast that, I'll show you another one that just shows the difference. And so there's different funds will invest into different investments based on their investment philosophy. So Vanguard's is a low cost index based approach. So this is another fund that we have on our approved list here at Canars called the Fidelity Australian Equities Funding. You'll notice some similarities, but you'll also notice some in it as well. Holdings. So we've got a couple of similar names here. We've got CBA, BHP, CSL. We've got Coal, so that's a different one in there. So they're making some active decisions around which shares they might think might do a better job in the long term. They've got Domino's Pizza there, so they think that people are going to be eating up more pizza. Goodman Group, Suncorp, Ramsay Health, Seek. So Seek's an interesting one, given jobs and that sort of thing. So yeah, very, very interesting. So yeah, all funds are completely different with the way they manage their money. So it's about finding one that you think's going to fit your investor profile the best. And that was just a quick overview of shares. If there's any questions, I'm more than happy to take them, or if there's any questions for Bryce. No, all silent. Well, we won't hold it up any longer, then we might wrap it up there. So thanks everyone for attending. We will send out the copy of the slides tomorrow. We will have a link to the survey, so if you could be kind enough to give us a bit of feedback, even on other topics you'd like us to see present in the future. We're trying to stick to monthly webinars to sort of help provide more education to clients. So we want to hear what you want to hear. So. Very good.
Both of you. It's been really good, really informative. So thank you.
That's right. Thanks for having me again. I'll shoot those slides over as well, because I did make a couple of changes since we last spoke.
Yeah. And I really feel sorry for you in Melbourne. So
hopefully the signs are good. The numbers are going down. It's just on a breath. Still a few weeks left, but I'm just looking forward to hopefully borders opening and I can come up and visit properly and do a bit of travel up to Queensland again.
Yeah, the sun is shining in Queensland, that's for sure, and we can go wherever we want to, Bryce. So.
Yes, I think it's very much now when will you guys accept me, as opposed to when am I allowed to go up? So.
I'm going to the beach on Saturday, so I'll take a photo and send it to you.
Yes. Instead of the sand and the water, and the sand and water isn't within 5 kilometres of where I live in Melbourne, so unfortunately I can't reciprocate.
No, so thank you very much for your time, mate. It's really appreciated. So thank you.
Perfect. Thanks, guys. You guys all have a good night.
See you.